Hello, I'm Professor Donna Byrne, and this is an estate and gift tax video. Even though it says it's about income taxation, we're just filling in some income tax concepts before we get going with the gift tax itself. So let's see what we've got here. These materials are based on Will Banks' Federal Taxation of Wealth Transfers, 3rd editions. And our objectives for this video are to describe the basics of income taxation for trusts and also estates, but we'll really be thinking about trusts. Explain in general terms what is meant by a grantor trust, and describe the implications of being a grantor trust. Okay, we'll start with a little review. Some of the features of trusts. First of all, a trust is a separate entity. It's a separate person. It has its own tax ID number. It owns property in its own right. And as you will recall from estates and trusts, it is effective to transfer property. So what's owned by a trust is not owned by the decedent. A trust is created when someone transfers property to a trustee to hold for the benefit of someone else. And that means that legal title is separate from beneficial interest. The trustee's name goes on the title, but the beneficiary lives in the house if that's what the trust owns. This is critical. There has to be separation of title between the trustee and at least one of the beneficiaries. And we call the trust principle the corpus or the res or the principle. All these things mean the same thing. We will use the terms corpus and principle in this course more or less interchangeably. The trust principle could be any kind of property. A house, a farm, stocks, bonds, collections, and so on. Most of the time in this course, the trust property will be something that earns income, but it could be anything. Beneficiaries receive interests in the trust, and a beneficiary can receive an income interest or a remainder interest. It could be a present interest or it could be a future interest. The trust itself could be revocable or irrevocable. The beneficiaries still receive interests, and those interests, as we will see, have value. So, if you are a beneficiary, you would probably rather have an interest in a non-revocable or irrevocable trust. You'd probably prefer an interest with no contingencies, and nevertheless, even if you end up with a contingent future interest or a revocable interest, that interest still has value today. The values of all of the beneficial interests add up to the value of the corpus. So, for example, let's say a trustee holds $1 million to pay income to A for life and then remainder to B, to distribute the corpus to B. And let's say A is 55 years old and the relevant federal interest rate is 4%. Well, we go to Table S, and you should have Table S somewhere in the back of your Code and Regulations supplement. It's published by the IRS. And we look up the interest rate and we look up the age of the life beneficiary. And it tells us that the remainder is worth 0.40131, or about 40% of the value is in the remainder. And then the lifetime interest has the rest of the value. So for our $1 million trust, $1 million trust, the lifetime interest is worth $598,690. And the remainder is worth $401,310. And that, if you think about the remainder, that's the amount you'd have to invest today at that 4% interest rate, so that at the end of the life expectancy of A, you would have exactly $1 million. because that's what you're going to get. You're going to get the remainder is going to get that corpus. Okay, let's move this on. Okay, so now we're going to shift gears and look at the income taxation of trusts. And these rules are found in subchapter J. And we're just going to kind of scratch the surface and look at some basics. General rule, when a trust earns income, the income is gross income just like for anybody else. And then when a trust distributes current income to beneficiaries, the trust gets a deduction. So, and then the beneficiaries would include the current income in their gross incomes. So that means that a trust that earns income and distributes all of it doesn't actually pay income tax, right? All of its gross income is offset by that deduction for what it pays out to the beneficiaries. If a trust must distribute all of the current income and only the current income, we call it a simple trust. When the trust can accumulate income or distribute corpus, it's a complex trust. But the basic rule still applies. The trust gets a deduction for the current income that it distributes each year. And the beneficiaries have gross income when they receive distributions of current income. Now, when a trust can accumulate income or distribute corpus, it's a complex trust. I just read this. If the trust accumulates income, in other words, doesn't distribute it all, then it will be subject to income tax, and it will pay rates found in section 1E. You should look at 1E. Here it is. It's kind of small on this slide, and I can't really read it without my glasses, so let's go like this. The thing to notice about this is that the rates are the same rates that we individuals pay, but look how fast it gets to the highest rate. Basically, almost all of the trust income is taxed in the highest rate, and that kind of is an incentive not to pay trust income tax. So the trust will have to keep track of its accumulated income that's already been taxed. There's no deduction when the trust distributes something that has already been taxed. And the beneficiaries don't have income when they receive amounts that have already been taxed. And it gets a little complicated. It's beyond our scope here, but you need to just sort of know that this scheme exists so that if it comes up for you, you can educate yourselves. Okay, now some trusts aren't subject to these rules. Instead, we just pretend that the grantor still owns the property, and we tax the grantor under sections 671 to 679. These are the grantor trust rules. So essentially, we're going to treat the grantor as owning the property. And so our question is, when do these rules apply? Basically, if the grantor has held on to some strings, the trust will be a grantor trust. And that means a right to control things, to revoke, to change beneficiaries. So for example, George creates an irrevocable trust with income to A and remainder to B, but retains the right to add income beneficiaries. Okay, so now think, how happy are you if you're A, and how happy are you if you're B? So we're going to consider these same kinds of issues in other contexts as well. Okay, now think about B's interest, B's remainder interest. That's pretty much locked in, right? Nothing can change that. But A's interest, A's income interest, that could be really diminished if George adds a bunch more beneficiaries. A can't really count on very much. And so because George has retained the right to change A's interest, he's treated as the owner of the income, and he's the one who will be taxed on that income. So here's a list of some of the times that we treat the grantor as the owner. I'm going to pop out. If there's a reversion worth at least 5% of the trust value, if the grantor or another person has a right to affect beneficial enjoyment. If the grantor can dispose of the property for less than adequate consideration, which is essentially like revoking part of the trust. And of course, if the grantor can revoke the trust and take the corpus, or if the income can be paid to the grantor or the grantor's spouse, or to pay for the premiums on the grantor's life insurance. Now, in all of those situations, the grantor is really able to act like an owner in some way, and so for income tax purposes, that's how we treat the grantor. Now let's return to our trust with George and A and B, right? And George is able to add income beneficiaries. What if George could only add the income beneficiaries with A's consent? That's a little bit of a different twist on it, right? That's different. Because now A could veto the adding of any additional beneficiaries. A has a substantial adverse interest to G's exercise of the power. A has a reason to care whether G does this. And sometimes we say that A is an adverse party, but it's really A's interest is adverse to George exercising this power. So in that case, we don't treat George as the owner. Now, what if George, same thing, could add income beneficiaries, but only with B's consent? Is that the same, or is that should we tax George on the income? Well, B does have an interest in the trust. He's going to get the remainder, but B doesn't really care who's getting the income. Right? B has no reason to give a hoot. And so essentially B, we could expect, would probably just go along with what George wants. B's interest is not a substantial adverse interest. And so should George be taxed on the income? Yes, George still has control of the income all by himself. And that's Bruiser. Now, this was just a brief overview. We will work on problems in class. Thank you for watching.